Howard Marks' The Most Important Thing. Uncommon Sense for the Thoughtful Investor is a must-read for investors seeking to enhance their decision-making process. Marks, a co-founder of Oaktree Capital Management and one of the most successful investors of his time, shares his insights into value investing, risk management, and contrarian thinking. The book revolves around what Marks considers the most important aspects of investing, presented in a thoughtful and philosophical style. Here's a detailed summary of the book's core ideas. The importance of second-level thinking. Marks distinguishes between first-level thinking and second-level thinking. First-level thinking, simple and superficial, for example, this stock is going up, I should buy it. Second-level thinking, deeper and contrarian. For instance, everyone thinks this stock is a good buy, but is the optimism already priced in? Successful investors must think differently and more insightfully than the crowd to achieve superior returns. Understanding risk. Marks emphasizes that risk is not the same as volatility. Instead, it is the possibility of permanent capital loss. Key concepts include managing risk. Avoiding big losses is more important than chasing high returns. The asymmetry of risk. Losses are harder to recover than gains, so investors should always prioritize risk control. Value investing. Marks advocates for a value-based approach. Buy assets below their intrinsic value. Focus on the margin of safety, the difference between the purchase price and the asset's actual value, providing a cushion against potential errors. He warns against chasing overpriced assets, even if they're popular. The role of market cycles. Understanding market cycles is critical for timing investments. Markets are cyclical, driven by changes in psychology, like optimism and pessimism and fundamentals. Marks encourages investors to recognize where the market is in its cycle and adjust their strategies accordingly. For example, be aggressive in downturns and defensive in booms. The impact of psychology on investing. Marks highlights the importance of investor psychology. Human emotions like greed and fear drive market behavior, leading to overvaluation or undervaluation of assets. Successful investors must remain disciplined and avoid emotional reactions, especially during market extremes. Contrarian thinking. To achieve superior results, investors must be contrarian. Buy when others are selling and sell when others are buying. Resist herd mentality, as the consensus is often wrong at turning points in the market. The importance of patience and discipline cannot be overstated. Marks emphasizes that investing is a long-term game. Be patient and wait for opportunities where the odds are in your favor. Avoid overtrading and the temptation to act unnecessarily during periods of market noise. Focusing on the process, not just the outcomes, is crucial. Success in investing should be measured by the quality of the decision-making process, not just the outcomes. A good decision can sometimes lead to a bad result, and vice versa because of the role of luck in investing. The key is to focus on making well-reasoned decisions over time. The role of risk aversion is another critical aspect highlighted by Marks. Always consider what could go wrong before making an investment. Accept that sometimes the best action is to do nothing if the risks outweigh the potential rewards. The concept of the most important thing. Throughout the book, Marks presents several most important things, including thinking differently, managing risk, knowing the market cycles, and being patient and disciplined. The overarching lesson is that successful investing requires a combination of these principles applied consistently. The limits of forecasting. Marks is skeptical of predictions. Markets are complex and unpredictable. Instead of trying to predict the future, investors should focus on understanding current conditions and positioning themselves accordingly. Appreciating the role of luck. Marks acknowledges the role of luck in investment outcomes. Even well-thought-out strategies can fail due to external factors. Successful investors should remain humble and acknowledge what they don't know. Control over emotions. Emotional discipline is crucial in investing. Avoid succumbing to fear during market downturns or greed during bubbles. Remaining rational and detached is one of the hallmarks of successful investors. Key takeaways: think differently. Success requires going beyond conventional wisdom and thinking at a deeper level. Risk management is paramount. Avoiding losses is the foundation of a sound investment strategy. Market cycles matter. Recognize where you are in the cycle and adjust your approach. Be patient and disciplined. Long-term success is built on consistent, thoughtful decision-making. Focus on intrinsic value. Always seek assets trading below their intrinsic value with a margin of safety. The most important thing is a thoughtful and philosophical guide to investing, combining timeless principles with practical wisdom. It encourages readers to think critically, act cautiously, and remain disciplined in their approach to markets. Like and subscribe. It helps grow the channel.